History is being written right now, not in some distant future, not in some theoretical scenario. Right now, today, December 25th, 2025. While most of the Western world is celebrating Christmas, something extraordinary is happening in the silver market. Something that hasn't been seen in modern financial history. Something that could change everything we thought we knew about precious metals pricing. Silver in Shanghai just hit $78 per ounce. Let that sink in for a moment. $78. While the Western markets, the COMEX, the London bullion market, are trading silver at around $72, that's a $6 to $8 premium. In the precious metals world, that's not just unusual, that's seismic. That's a flashing red alarm that the entire global pricing mechanism for silver is breaking down before our eyes. Today, we're going to dive deep into what's happening right now in Shanghai. We're going to understand why this matters. And we're going to explore what this could mean for the future of silver, for the global economy, and potentially for your financial future. This is not clickbait. This is not hype. This is documented, verifiable market data showing us that the rules of the game are changing in real time. So buckle up, because what you're about to learn might challenge everything you thought you knew about how precious metals are priced in the modern world. Let's start with the hard data, because numbers don't lie. As of December 24th and 25th, 2025, physical spot silver on the Shanghai Gold Exchange and futures on the Shanghai Futures Exchange hit levels between $78 and $79 per ounce when converted from Chinese yuan to US dollars. Meanwhile, the Western markets, specifically COMEX futures and London spot silver, are trading around $71 to $72 per ounce. Do the math. That's a premium of $6 to $8 per ounce in Shanghai. Now, if you're not familiar with precious metals markets, you might be wondering, so what? Prices differ between markets all the time, right? Wrong. In the precious metals world, particularly with silver and gold, there's something called arbitrage. This is the practice where traders buy low in one market and sell high in another, profiting from the price difference. This activity normally keeps prices across global markets within pennies of each other, not dollars, pennies. When you see a $6 to $8 gap, arbitrage should theoretically kick in instantly. Traders should be buying silver in New York at $72 and selling it in Shanghai at $78, making a quick profit while simultaneously closing that gap. But that's not happening. The gap is persisting, it's widening, and that tells us something profound. There's a physical shortage so severe in China that no amount of arbitrage can close it. Let's look at some more numbers to understand the scale of what's happening. The Shanghai Futures Exchange inventories fell to just 881.949 tons as of December 24th, 2025. To put that in perspective, warehouse holdings at the Shanghai Futures Exchange have plummeted to approximately 531,211 kilograms. That's the lowest level since 2015, a full decade low. These aren't just statistics. These are warning signs of a supply crisis that has been building for years and is now reaching a critical breaking point. And here's the kicker. Silver is up approximately 140 to 150% year to date in 2025. That's not a typo. We're talking about gains that rival or exceed some of the best performing cryptocurrencies or tech stocks for a physical commodity. For a precious metal that's been around for thousands of years, the spot silver price hit a record high of 72.70 ounces on December 24th, putting silver on track for its best annual performance since 1979. 1979, that was the year of the Hunt brothers' attempt to corner the silver market. That was 46 years ago. We are witnessing history. Now, there's a technical term that keeps appearing in discussions about the Shanghai silver situation: backwardation. If you're not familiar with commodity markets, backwardation might sound like complicated financial jargon. But it's actually a simple concept with profound implications. In normal market conditions, something called contango exists. This means that futures contracts for delivery months further in the future trade at higher prices than spot prices or near-term futures. Why? Because there are costs associated with storing, insuring, and financing physical commodities over time. It costs money to hold silver in a vault for 6 months or a year, so futures contracts for later delivery typically trade at a premium. Backwardation is the opposite. It occurs when spot prices or near-term futures trade higher than contracts for future delivery. And this is happening right now in Shanghai. The AG T+D spot contract, which represents immediate or very near-term delivery, is trading significantly higher than future delivery contracts. Why does this matter? Backwardation signals one thing: immediate scarcity. It means that buyers are willing to pay a massive premium to get their hands on physical silver right now, today, rather than waiting for future delivery. It means that the market believes silver is more valuable in your hand today than it will be in 3 months or 6 months. This completely defies normal market logic. Under typical conditions, you should be rewarded for waiting because the seller has to store and finance the commodity. But when backwardation appears, it means the market is screaming, "We need this metal now, and we'll pay whatever it takes to get it." In the silver market specifically, sustained backwardation has historically been extremely rare. When it appears, it's often a precursor to explosive price moves. Think about what's really happening here. Industrial users in China, the companies making solar panels, electric vehicle components, smartphones, and advanced electronics, they can't afford to wait. Their production lines need silver today. Not next month, not next quarter, today. And they're willing to pay $78 per ounce, while the rest of the world is still pricing silver at $72 because they have no other choice. The alternative is shutting down production lines, missing delivery deadlines, losing contracts. In the hyper-competitive world of Chinese manufacturing, that's not an option. So they pay the premium, and the backwardation persists, and the price keeps climbing. But backwardation is just one piece of the puzzle. To really understand what's happening, we need to look at the broader supply and demand picture. Let's talk about where silver comes from and why there's suddenly not enough of it. Silver is mined in various locations around the world, with major production coming from Mexico, Peru, China, Russia, and Chile. But here's something most people don't know. Most silver is not actually mined as a primary product. Approximately 70% of silver production comes as a byproduct of mining other metals, particularly copper, lead, and zinc. This creates a unique supply dynamic. When copper prices fall, or when base metal mines slow production for economic or political reasons, silver production also falls, even if silver prices are rising. Miners can't simply turn on more silver production in response to higher prices, the way they might with a primary mining product, and that's exactly what's been happening. Global supply has remained constrained due to production slowdowns in major mining regions like Peru and Mexico, political instability, labor disputes, permitting issues, declining ore grades, and environmental regulations have all contributed to production challenges. Meanwhile, demand has been exploding. China dominates global silver consumption, accounting for over 50% of industrial silver use. And Chinese industrial demand has been on a tear. The solar panel industry alone is consuming silver at unprecedented rates. Every solar panel contains silver paste in its photovoltaic cells. As China races to dominate the global renewable energy market and expands its own domestic solar installations at breakneck speed, silver consumption from this single sector has skyrocketed. Then there's the electric vehicle revolution. Silver is used extensively in EV electronics, battery management systems, and charging infrastructure. China is the world's largest EV market, and production is accelerating every year. Add to that traditional electronics manufacturing, smartphones, tablets, computers, all of which require silver for various components, and you have a demand profile that's growing faster than supply can keep up. But it gets more interesting. China has announced that export restrictions on silver will take effect on January 1st, 2026. That's just days away from the time of this recording. These restrictions will limit silver exports to only state-approved producers, effectively giving the Chinese government control over who gets Chinese silver and who doesn't. Think about the strategic implications of that. China is signaling to its domestic industries, we're keeping the silver we produce for ourselves. We're not going to let this critical industrial metal flow freely to foreign competitors, and the market is responding accordingly. Companies are scrambling to secure supply before these export restrictions kick in. They're hoarding. They're building stockpiles. They're paying massive premiums in Shanghai because they know that in a few days, getting silver out of China might become significantly more difficult. This brings us to the inventory situation we mentioned earlier. Shanghai Futures Exchange inventories at a 10-year low. This isn't a temporary blip. This represents years of withdrawals exceeding deposits, of industrial consumption outpacing supply additions, of a structural deficit that's been building beneath the surface. Here's a critical data point. In recent weeks, tens of tons have been removed from Shanghai vaults. During a time when prices are spiking, when backwardation indicates immediate scarcity, inventory is still flowing out of warehouses at an accelerating rate. What does that tell us? It tells us that despite prices hitting $78, $79 per ounce, despite the massive premiums, buyers are still willing to pull physical metal. They're not waiting for prices to come down. They're not assuming this is a temporary spike. They're acting like this is the new reality. And there's one more factor we need to consider. Lease rates. Silver lease rates are the interest rates paid to borrow physical silver. Under normal market conditions, these rates hover below 1%. They're typically very low because silver is abundant and lenders don't perceive much risk. But in October of 2025, silver lease rates spiked to 32%. 32% to borrow a commodity that normally lends at less than 1%. That's not just unusual, that's unprecedented in modern markets. It indicates that holders of physical silver are extremely reluctant to lend it out, even at extremely high interest rates, because they believe either they won't get it back or that having physical possession is more valuable than earning 32% interest. When we put all these pieces together, the supply picture, declining mine production, exploding industrial demand, export restrictions, collapsing inventories, extreme backwardation, and extraordinary lease rates, we're looking at a perfect storm. This isn't just a tight market. This is a market in crisis. And Shanghai is the epicenter. Now, any discussion of the Shanghai silver surge would be incomplete without addressing the speculative element, because alongside the legitimate industrial demand and physical shortage, there's been an absolute frenzy of speculative buying in China. China's only pure-play silver fund, the UBS SDIC Silver Futures Fund, experienced something extraordinary in December. The fund gained nearly 220% in 2025. Think about that. More than tripling in a single year. By Wednesday, December 24th, the premium of this fund over its underlying asset, meaning the actual value of the silver it was supposed to track, stood at nearly 62%. It had started December at a 7% premium. In other words, investors were so desperate to get exposure to silver that they were willing to pay 62% more than the actual value of the silver the fund held. They were essentially paying $1.62 for every dollar of actual silver value. That's not investing. That's speculation verging on mania. The fund hit its upward limit, a 10% daily gain for 3 straight days. Chinese markets have circuit breakers that prevent securities from moving more than 10% in a single day. This fund was hitting that limit day after day as buyers piled in. Then, on Thursday, December 25th, reality set in. The fund plunged by its maximum daily limit of 10% on the downside. The buying frenzy turned into a selling panic, at least temporarily. UBS SDIC fund management responded by tightening rules on Wednesday evening, attempting to cool the speculation and prevent the fund from becoming completely disconnected from reality. This is a classic speculative bubble pattern. Prices rise, attracting attention. More buyers enter, pushing prices higher. The rate of increase accelerates. Premiums over actual value expand to absurd levels. Then, something triggers profit-taking or fear, and the speculative element collapses. But here's what's critical to understand. The speculative bubble in the fund does not invalidate the underlying physical market dynamics. Yes, there was clearly excessive speculation in the silver fund. Yes, retail investors in China were chasing returns and got caught up in the momentum. Yes, the 62% premium was completely unjustifiable. But the physical silver market, the actual spot prices in Shanghai, the inventory drawdowns, the industrial demand, the export restrictions, those are all real. Those aren't speculation. Those are fundamental supply and demand factors. The fund was a symptom of the broader excitement and mania, but the disease, if we can call it that, is the actual physical shortage. What we're seeing is a 2-layered phenomenon. On one layer, there's genuine structural tightness in the physical silver market, particularly in Asia. On another layer, there's speculative fervor as traders and retail investors try to profit from or get exposure to that tightness. The speculative layer can and will experience volatility, bubbles, and crashes. That's the nature of speculation. But the underlying physical dynamics don't disappear just because some speculators got burned on an overhyped fund. In fact, speculative bubbles often occur because there's a kernel of truth at the center. Speculators identify a real trend, a real shortage, a real change in market dynamics, and then they push prices far beyond what the fundamentals justify in the short term. But when the speculation cools, we're left with the fundamentals. And the fundamentals in the silver market right now are extraordinarily bullish. The question isn't whether speculation has played a role. It clearly has. The question is what happens when the speculative froth clears, and we're left looking at the actual supply and demand picture. And that picture shows China consuming more silver than can be sustainably supplied, inventories at decade lows, export restrictions about to take effect, and Western markets still pricing silver as if none of this matters. This brings us to perhaps the most significant implication of what is happening in Shanghai, the decoupling of Eastern and Western silver markets. For decades, the global price of silver has been set primarily in Western markets. The COMEX Futures Exchange in New York and the London Bullion Market have been the primary venues for price discovery. When someone asks, what's the price of silver? They're typically referring to the COMEX spot price or the London fix. But something fundamental is changing. Shanghai is beginning to set its own price. And that price is significantly higher than the Western price. And it's staying higher, persistently, stubbornly. This is what market observers are calling the East-West decoupling. The idea that Eastern physical markets and Western paper markets are diverging, potentially permanently. Let's understand what's driving this. The Western silver market, particularly COMEX, is predominantly a paper market. Yes, there's physical delivery available, but the vast majority of trading is in futures contracts that are settled in cash, never resulting in actual physical metal changing hands. This creates a market where the price is determined more by financial flows, by hedge fund positioning, by algorithms and traders, than by actual physical supply and demand. The Eastern market, particularly Shanghai, is much more physical in nature. The premiums we're seeing reflect actual buyers who need actual metal for actual industrial production. They can't settle in cash. They need the physical bars and coins. When these two market structures diverge, interesting things happen. In a paper market, prices can be suppressed through futures selling. Hedge funds, banks, and large institutions can sell futures contracts to push prices down, profiting as prices fall, without ever needing to deliver physical metal. They're just trading contracts. But in a physical market, you can't sell what you don't have. If Shanghai buyers want physical silver and there's not enough physical silver available, the price has to rise until either supply increases or demand decreases. There's no way around it. What we're witnessing is the physical market asserting itself. Shanghai buyers are essentially saying, we don't care what the paper price in New York is. We need metal, and we'll pay what it takes to get it. This creates a fascinating dynamic. Under normal circumstances, arbitrage would close the gap. Traders would buy physical silver in New York at $72, ship it to Shanghai, and sell it at $78, making a nice profit. But several factors are preventing this arbitrage from working efficiently. First, logistics and timing. Shipping physical silver from New York to Shanghai takes time. In a fast-moving market, prices can change during that transit period. Second, the upcoming export restrictions from China. Even if you can get silver into China, getting it back out is about to become much more difficult. That creates a one-way flow problem. Third, and perhaps most importantly, there may simply not be enough physical silver available in Western vaults to satisfy Eastern demand at current prices. This last point is critical. If Western vaults are also experiencing drawdowns, if there's less physical metal actually available than the paper market suggests, then arbitrage can't work because there's nothing to arbitrage with. Some analysts believe this is exactly what's happening. They argue that the Western paper market has created a situation where far more silver exists on paper in the form of contracts and certificates than actually exists in physical form in vaults. As long as everyone is content to trade contracts and never take delivery, this system works fine. But the moment someone says, I want my physical metal, problems emerge. And that's what China is doing. China is essentially standing for delivery on a massive scale. Chinese industrial users are saying, we need the actual metal. We're not interested in your contracts. Give us the bars. And the West may not have enough bars to give them at the current paper price. This is why the premium in Shanghai is so significant. It's not just a price difference. It's a signal that the entire global pricing mechanism for silver may be breaking down. The question everyone is asking now is, which market will ultimately determine the price? Will Shanghai's premium pull Western prices higher? Or will Western prices somehow force Shanghai prices back down? History suggests that physical markets ultimately win. You can manipulate paper markets through contract selling and financial engineering, but you can't create physical metal out of thin air. At some point, physical scarcity asserts itself, and prices must rise to reflect that reality. If this decoupling persists, if Shanghai continues to trade at substantial premiums, we could see several outcomes. One possibility is that Western prices are forced higher as physical delivery requests on COMEX increase. If arbitrageurs or industrial users start standing for delivery in New York to ship metal east, COMEX inventories would decline, potentially triggering a squeeze. Another possibility is that the two markets continue to diverge, with Shanghai trading at persistently higher levels, effectively creating a two-tier global silver market, one for paper contracts in the West and one for physical metal in the East. A third possibility, and perhaps the most disruptive, is that the Western paper market loses credibility entirely. If buyers globally lose faith in the idea that COMEX contracts represent real, deliverable silver, they may abandon those markets in favor of physical markets like Shanghai. This would cause a massive repricing event as decades of paper market price suppression unwinds. We're not making predictions here. We're simply outlining the possible scenarios. But what's undeniable is that something significant is happening right now. The rules of the game are changing, and Shanghai is leading that change. Traders on social media platforms are already discussing this openly. Comments like, Shanghai sets the price now and physical over paper are becoming common refrains. There's a growing sentiment that the era of Western price dominance in precious metals may be ending. And if that's true, if we're witnessing a fundamental shift in how silver is priced globally, then the implications extend far beyond the silver market itself. Let's zoom out and consider what this Shanghai silver situation means for the broader economy and financial system. First, there are direct industrial implications. Silver is a critical input for numerous technologies. Solar panels, as we've discussed, use significant amounts of silver. If silver prices continue rising, solar panel costs will increase, potentially slowing the global transition to renewable energy. Electronics manufacturing will face higher costs. Every smartphone, tablet, computer, and appliance that uses silver will become marginally more expensive to produce. In a world already dealing with inflation, this adds another cost pressure. Electric vehicles will be impacted. The EV revolution depends on affordable components, and silver is embedded throughout EV electrical systems and charging infrastructure. China, as the dominant player in all these industries, faces a strategic choice. Do they continue exporting finished goods like solar panels and EVs at competitive prices while paying higher silver input costs? Or do they pass those costs on to international buyers, potentially losing market share? Or do they use their control over domestic silver supply through the upcoming export restrictions to ensure Chinese manufacturers have preferential access to silver at lower prices than international competitors? This would be a form of industrial policy using resource control to maintain competitive advantage. The implications for global trade and competition could be significant. Silver, along with gold, has historically been considered a form of money and a store of value. When faith in fiat currencies declines, when central banks print money aggressively, when geopolitical tensions rise, investors traditionally turn to precious metals. The extraordinary gains in silver this year, up 140 to 150%, reflect in part a growing concern about currency debasement and economic instability. The US dollar index has hit its lowest level since October. This makes dollar-denominated commodities like silver more attractive to international buyers. It also reflects ongoing concerns about U.S. fiscal policy, deficit spending, and the long-term value of the dollar. Central banks, particularly in BRICS nations, Brazil, Russia, India, China, and South Africa, along with other countries seeking to reduce dollar dependence, have been rotating reserves into gold and silver. The People's Bank of China has been a notable accumulator. This isn't just about investment returns. This is about countries positioning themselves for a potential future where the dollar is no longer the dominant global reserve currency. Precious metals provide an alternative store of value that doesn't depend on any single nation's fiscal policy or central bank decisions. If the East-West decoupling in silver markets persists and expands, it could be an early indicator of broader economic and monetary decoupling. A world where Western financial markets and Eastern physical markets operate increasingly independently, with different prices, different rules, and different power dynamics. Third, there are geopolitical implications. Control over critical resources has always been a source of geopolitical power. In the 20th century, oil was the critical resource. Nations that controlled oil production wielded enormous influence. In the 21st century, as we transition to electrification, renewable energy, and advanced technologies, the critical resources are shifting. Lithium, cobalt, rare earth elements, and yes, silver are becoming strategically important. China has been positioning itself for years to control these supply chains through domestic production, through investments in mining projects globally, through processing and refining capacity, and now through export restrictions. China is asserting control over resources critical to the industries of the future. The Shanghai Silver Premium is a small but significant example of this broader strategic positioning. China is demonstrating that it can set prices for critical resources within its market, regardless of what Western markets say. That's a form of economic power. If other nations want access to Chinese silver, to Chinese solar panels, to Chinese batteries, they may increasingly have to play by Chinese rules, price at Chinese prices, settle in Chinese currency. This is part of a larger story about the changing global economic order. The post-World War II system, where Western institutions, Western markets, and the US dollar dominated, is evolving. New power centers are emerging. New markets are asserting themselves. New rules are being written. Finally, there are implications for individual investors and savers. If silver prices are genuinely being suppressed in Western paper markets while physical scarcity drives Eastern prices higher, then anyone holding physical silver may see significant appreciation as this discrepancy resolves. Conversely, anyone holding silver through paper instruments, ETFs, futures contracts, or certificates may find that when they try to convert to physical, the price they have to pay is much higher than the paper price suggested. This is the difference between having a claim on silver and actually owning silver. In times of shortage, that difference becomes critically important. First, watch the Shanghai Premium. If it persists, if it widens further, that confirms that the physical shortage is real and worsening. If it narrows or disappears, that suggests either supply has increased or demand has decreased, or that arbitrage is finally working. Second, watch COMEX inventories. If we start seeing significant drawdowns in COMEX silver stocks, that indicates that physical delivery requests are increasing, that metal is flowing east, and that Western markets are feeling the same physical pressures as Shanghai. Third, watch the export restrictions. January 1st, 2026 is the implementation date for China's silver export controls. What happens in the first few weeks and months after those restrictions take effect will tell us a lot about how serious China is about controlling this resource and what impact that has on global availability. Fourth, watch industrial users. If companies in the solar, electronics, or EV industries start reporting challenges sourcing silver, Or if they announce price increases due to silver costs, that confirms that the industrial demand story is real and impacting actual production. Fifth, watch currency markets. The dollar's weakness has been a contributing factor to precious metal strength. If the dollar weakens further, that could add fuel to the silver rally. If the dollar strengthens, it might provide temporary relief. Sixth, watch geopolitical developments. Tensions in the Middle East, developments in Ukraine, US-China relations, BRICS currency initiatives, all of these factors influence safe haven demand for precious metals. Finally, watch for regulatory or policy responses. If Western governments or financial authorities perceive a crisis developing in silver markets, they may take action. Position limits on COMEX, restrictions on ETF redemptions, or other interventions could be implemented. Some analysts are predicting that silver could reach $100 per ounce in 2026 if production fails to recover and industrial demand remains strong. That's not a fringe prediction anymore. Given that Shanghai is already trading near $80 and Western markets are at $72, $100 doesn't seem unreasonable if current trends continue. Others are more cautious, arguing that the speculative bubble will burst, industrial demand will slow as prices rise, and additional supply will come online in response to higher prices, bringing the market back into balance. The truth is, nobody knows for certain. Markets are complex, dynamic systems influenced by countless variables. Predictions are just educated guesses. But what we can say with certainty is that something extraordinary is happening right now. The Shanghai silver surge to $78, the massive east-west premium, the inventory drawdowns, the backwardation, the export restrictions. All of these factors together represent a significant market event. Whether this is the beginning of a sustained structural shift in silver markets or a temporary dislocation that will resolve over the coming months remains to be seen. But for anyone interested in precious metals, in commodity markets, in global trade dynamics, or in the evolution of the international economic order, what's happening in Shanghai right now deserves attention. Because this isn't just about silver. It's about price discovery. It's about physical versus paper markets. It's about East versus West. It's about who controls critical resources and who sets the rules. And in that larger context, the silver market might just be the first domino to fall. It already started. That's not hype. That's not sensationalism. That's just a statement of fact based on the data we have right now. Silver in Shanghai hit $78, while Western markets remained at $72. That gap represents something breaking down in the global pricing mechanism. Whether that breakdown is temporary or permanent, whether it resolves peacefully or disruptively, whether it's an anomaly or the new normal, these are the questions we'll be answering in the weeks and months ahead. But what's undeniable is that the situation is fluid, it's evolving rapidly, and it matters. Stay informed. Watch the data. Think critically. And understand that in times of major market transitions, being aware of what's happening gives you an advantage. The silver story is just beginning, and Shanghai just wrote an important chapter. Thanks for watching. Stay sharp out there.